also have some breaking data crossing the terminal right now, and Bloomberg's Michael McKee has the details.
Well, Shonali, life would be a lot easier for traders if we didn't have contradictory information, contradicting data coming in. The ISM Services Index actually falls a little bit to 51.4 from 52.6. The prices paid number goes down to 53.4 from 58.6. So about as big a move down in prices paid for services as we saw as a move up in the prices paid for manufacturing. The other number people care about is ISM employment in the services industry. It rises, but only to 48.5 from 48, so no real change. Still below 50, still suggesting that we are seeing some contraction in employment in the services of business. New orders come in at 54.4, that's down from 56.1. So all in all, this is a good report, but slightly weaker than it has been, and that sort of breaks this chain of strong reports that we have seen all week.
Well, what do traders listen to here? Because just as I was on the board there, you had two-year yields above 73 for a moment there, getting back below 270. So how do you think about what's ahead?
Well, I suspect everybody's going to be focused now on Jay Powell this afternoon. There's not been enough data that would cause him to change his view. Maybe people are looking for a little more guidance on what they'll be looking at or how he describes the economy, since the numbers that we have had have come in, for the most part, strong or stronger than expected.
Yields now at 469 on the day, hanging below that to a 470 level. Mike McKee, thank you so much for your time, and certainly a lot of Fed speak ahead. We will talk to Mike McKee later in the day. But let's dive into those markets now, because we are joined by Kathryn Rooney Vera, StoneX Chief Market Strategist. You look at this conflicting data, and it is really throwing a wrench in a lot of the expectations we're seeing for rate cuts. But how do you read into the volatility at this point when you're looking for new money to put to work?
Well, volatility is too low, in my opinion. I think that a lot of the markets are anticipating this this perfect landing, and the risks are underpriced as pertains to the uncertainties inherent in this market. We could go one of two ways. We could see a reacceleration in the economy, which means reflation and a Fed that cannot cut, or God forbid even has to hike. Or we could see the rising risk of a Fed-induced recession with too high nominal rates and inflation continuing to fall, meaning that real rates really start to bite the U.S. consumer. So I think those two fat tail risks, Shonali, are currently underpriced in the market.
Where do you think they're most underpriced right now when you look at where prices have gone?
Well, I think a very safe bet is the front end of the U.S. Treasury curve. Yields have gone up tremendously, and if I'm right and the Fed does cut this year at least, let's say, 2 times, then we're going to see that big swath of cash that's sitting in money markets that's returning 5.3%, it's about, what, $6 trillion, is very likely to move into a complementary asset class, and that isn't equities. That would be the front end of the U.S. Treasury curve. So I think that's a nice hedge your bet type of trade in front of these markets, while maintaining some exposure, of course, to the equity markets, which you can protect yourself as well with pretty cheap put options at the money for 12 months out.
Well, how do you think about where exactly to put that money? Because if you're thinking that equities are a smart place to go, how do you think about the Mag 7 where it stands today, and frankly even some of the AI stocks that have flown away in recent months?
Well, I was looking at the numbers with our team at StoneX, and after the major breakout we've seen January 10th, which is defined as the highest, the market top in the past 2 years, or for the first time in a year, historically that implies around a 15% return for the next 12 months. And when you look at the breadth, 86% of the S&P 500 companies are above their 200-day moving average. So that's a good sign. That shows that the breadth is widening, and it's not just these Mag 7. But as I said, Shonali, I think it's an important consideration to think about buying protection, basically life insurance policy. You hope you don't need it, but when you have it, you're very, very, very happy that you do. And you can buy that protection pretty cheaply, around 4.5% put option on the S&P 500 for 12 months out at the money. And you can also protect those triple Qs, the technology sector as well. So you maintain your exposure to the equity markets and to this ongoing rally, which is likely to continue without some flop in unemployment and consumer, but you're protected.
Basically, you're saying keep buying but hedge.
Yeah, hedge yourself. I think it makes sense. Complacency is pretty high. There's euphoria in the markets. Everyone's discounting this perfect landing, underpriced risks. I think it makes sense to protect yourself at current levels.
Would you take profits further anywhere in this market right now, given that the breadth is kind of expanding in the market? Do you start to sell some of those high flyers and move in to some of those unloved stocks?
I do think it makes sense. I think, markets don't bottom at euphoric levels. So I think it makes sense to rotate out of the high flyers and move into the underperformers. And that's why I like the barbell approach, maintaining exposure to the cyclicals, but then buying those underloved sectors such as utilities and staples that have underperformed over the past year, but that in the event of we were talking about, oil prices potentially surging, if the Strait of Hormuz gets affected, oil could jump $40. That would incite inflation and have repercussions on the market. So I think it does make sense.
With so many people concerned about that re-acceleration of inflation, do you start to almost bet on it at this point? I mean, how do you think about what role inflation plays in the market today?
Well, if you look at the composition of core PCE, 1.8 percentage points of that last number of 2.8 comes from housing. So if in fact we do see housing drop in terms of prices, which new tenant rents is indicating will happen with a 4-month lag because new tenant rents has been dropping pretty precipitously, I think that could take some of the pressure off of inflation. I do have a 2.6% in core PC by the end of this year, but I think that's sticking. It's going to be hard to get to that 2% trend. So the Fed's going to have to make some tough choices, either an implicit higher target, which is no longer 2%, or break something to get to that 2% target.
When you think about what could get hurt under a higher inflation environment, where do you start to worry?
Yeah, so certainly the interest rate sensitive sectors, I think we run the risk of recession. So then you see leveraged loans, for example, which have outperformed massively in the fixed income space, get hit. High yield gets hit. You see the bringing forward of the credit cycle, Shanali, which we have not seen play out as yet. We haven't seen these large defaults that one would expect after 525 basis points in rate hikes. So I think that's where we would see some vulnerability were the Fed to have to maintain nominal rates as high as they currently are with real rates above 2.6%.
Kathryn, stick with us. That is Kathryn Rooney Vera of StoneX, who is going to hold on the conversation here. But we're going to first take a look at what's moving in markets with Bloomberg's Jess Menton. Jess, and we're back with Kathryn Rooney Vera, StoneX's chief market strategist. I love using Disney to talk about the Dow Jones Industrial Average. We're talking about breadth in the market here. How do you think about the indices as they stand?
Well, the estimated earnings growth for 1Q is 3.6%, which would, if it turns out to be the case, would be the third consecutive quarter of earnings growth, which is setting us up for a positive year this year. Historically, outside of recessions, Shanali, 2 consecutive years of negative earnings growth is rare. So I am still expecting 8% earnings growth for the S&P this year. And I suspect that even if the Fed isn't able to cut economic growth, the combination of economic growth and disinflation, if 2024 is a repeat of 2023, means the S&P can continue to move higher. But this is a market that's so built on this fundamental concept of soft landing that were it not to occur, the repercussions would be dramatic, which is why I think it's so important to protect that long positions.
Let's talk about anything outside of the S&P as well. There's been that Russell 2000 trade that has been brewing under the surface that has constantly gotten beaten down at any sign of inflation.
Yes.
So how do you think about how vulnerable those small and mid-cap stocks are right now?
That was one of my top trades coming into the year, and I had to close it out, Shanali, because the truth is that under the expectation of dramatic rate cuts, small caps would do remarkably well. And I also had the steepener call on which I had to close out. But those two calls do well with a Fed that cuts rates. Were it not to, because economic growth is growing 1 full percentage point above potential, and that is inherently reflationary, then they don't do so well. So I think that were inflation to remain sticky around 2.6 to 3.5%, small caps underperform, and we get an important retracement in duration as well.
Dare I say you're not the only one closing out trades out there. When you think about what we're facing just a week from now, you mentioned earnings. What are the big earnings upsets or surprises that you might expect?
I think that if we get some surprising economic data We've seen very mixed data, as you pointed out earlier this morning. If we get some surprising data on the labor front, then I think the cyclicals could be hard hit, especially the high flyers. So we get non-farm this Friday. I think it's going to be a good number, but the labor market is what the Fed is most focused on. So either a big upside surprise therein or a dramatic downside surprise, I think would bring volatility to the markets, especially those rate-sensitive sectors.
We say volatility, but how much volatility into which markets?
Yeah, I think tech, which is the leader, would face the most downside under an environment where the Fed cannot cut, and we enter a potentially stagflationary scenario, which I think is the biggest risk. So I would say the equity markets they're almost breaking 3 standard deviations from the mean, and in terms of their overvalued nature would be the hardest hit, which is why I continue to prefer a healthy portion of portfolio allocations invested in the front end of the Treasury curve. Gold is doing very, very well. It's one of my top picks, as well as cash instruments.
Now, it's interesting when we talk about tech, is tech a monolith? Do you think that there are some parts of tech that would be insulated? We've seen prior parts of the cycle where almost some of those big tech names have been like a shield.
That's right. That's a very good point. That's something that at StoneX I've been talking very at length with our clients, which is where can we find the tech trade that hasn't already been priced in? And there are opportunities within financials, within healthcare, subsectors of these areas, which have companies where you can stock pick and go in and say, okay, these guys are actually deploying AI, because at the end of the day, Shonali, what we're seeing is corporations like to talk a big game, but they haven't actually executed technology or AI. So I think AI has to deliver to maintain to maintain earnings growth and validate that multiple expansion, which drove the market last year.
When we're talking about tech spending, we're getting into CapEx investment, but when you're an investor and you're looking at these companies, what do you prefer at this point? Do you want them to be spending their cash on dividends? Do you want them to be buying other companies, going out there and acquiring as the M&A market comes back? Or do you prefer them to spend on technology, on AI moving forward?
Look, there's a lot of profitless tech companies. I think that this is a different market. I don't consider it a bubble similar to the tech rupture in 1999, principally because a lot of these companies are profitable, and I think there are legs to this rally. So I think the trick is to find those, as you mentioned, I think you alluded to this, find those sub-segments that have not yet priced in this improvement in productivity that I still think is in the offing from actual deployment of artificial intelligence.
And as we're talking here, we have the NASDAQ 100 also flipping into green territory, I think, on the day today, too. So if you do have, what is that interest rate level you think that will not impact kind of the exuberance we're seeing in the market, even if you expect less rate cuts?
If we get 50 to 75 basis points, I think that's going to be what the market is expecting. If we get 0, as I said, if economic growth does post 2% and we get 0 cuts and inflation ends at 2.6%, I think the S&P can be up another 15%, according to that major breakout theory. But then again, we do have those fat tail risks. So were the Fed unable to cut and have to hike, that's another story. So I think my base case scenario, Shonali, is 60% chance of a soft or no landing this year, 40% chance of stagflation coming into 24.
Kathryn Rooney Vera, we're going to have you back soon. Of course, that data changes daily. That is the Chief Market Strategist over at StoneX.